Trump says he's saddened to hear that factories are closing in China. China calls him a paper tiger and vows to stand firm in the face of his bullying. The stock market is trading as though the trade war is over or never started. Who do you believe? What should you be doing with your money right now? Trump's Liberation Day triggered a sell-off in stock markets worldwide. But in just 1 month, stocks have made a full recovery. At the time of the recording of this video, the MSCI World Equity Index has retraced back to its closing level on April 2nd, just before Trump's reciprocal tariff announcement. The reason for the market's renewed optimism is simple. The latest consensus on Wall Street is that 1. Trump will back down from his trade war, and 2. He will do so before his tariff inflict any real damage to the US economy. Rightly or wrongly, investors have concluded from Trump's decision on April 9th to hit pause on his reciprocal tariffs and the various exemptions that follow that he does not have the stomach for a long drawn-out trade war. As far as the market is concerned, Trump already blinked, and the war is now nothing more than a show. But is the market reading Trump correctly? Can it really be the case that Trump's trade war is over even before it started in earnest? To answer this question, let's take another look at the War of Attrition game, formulated by the British evolutionary biologist John Maynard Smith. In the simple version of this game, there are just 2 players competing for a prize. Before each round of the game, the players decide whether to play or to drop out. If one of the players decides to drop out, the game ends and the other player wins. The prize is worth V. For every round of the game played, the 2 players each incurred a cost of fighting equal to C. That's the setup of the game. There are 2 types of equilibrium in this game. In the first one of the 2 players drops out immediately. This pure strategy equilibrium is efficient to the extent that no resources are wasted fighting for the prize. The second type of equilibrium is a mixed strategy equilibrium. In this equilibrium, we can derive the dropout probability by assuming that the players are indifferent between dropping out at time t and dropping out at time t plus 1. Without going through the math, it turns out that the probability of dropping out is just P equals C divided by V plus C. What this equation says is that the greater is V, the value of the price, the lower is the probability of a player dropping out of the game, and the longer is the game. However, the greater is C, the cost of fighting every round, the higher is the dropout probability, and the shorter is the game. What does the War of Attrition game tell us about how long Trump's trade war will last? What it says is that the greater is the perceived price of the war, the longer the war will last. However, the greater is the cost of the war, the shorter it will be. So what are the price and the cost in this trade war? What is the price of Trump's trade war? It's pretty obvious that the price is different for the US and China and for everyone else. The stakes for the US and China are far higher than for everyone else. Let's not beat around the bush. This trade war is about global economic dominance. Its main purpose is to stop China from challenging American hegemony. J.D. Vance called the Chinese people peasants. John Ratcliffe, the director of the CIA, called China America's greatest threat. Kristi Noem, the Secretary of Homeland Security, called China an enemy of the United States. Marco Rubio, the Secretary of State, who accused China of cheating its way to superpower status in his confirmation hearing, described China's tariff as vital for American national security. Howard Lutnick, the Secretary of Commerce, promised that Trump's tariff would eliminate China's army of millions and millions of human beings screwing in little screws to make iPhones so that they can be built in America by robots. China hawks are in the driver's seat in Washington. And the DeepSeek news has only added urgency to their existential fears. For them, the price of this trade war is continued US dominance. What this means for our war of attrition game is that V is very high for the American side. Remember, higher V means lower probability of backing down in a longer war. But what about China? China has long maintained that it is only interested in strategic balance and not global domination. Whether this is true or not, China's stakes in Trump's trade war are no lower than those of the US. It has not been lost on the Chinese leadership that China is the real target of Trump's supposedly global trade war. In a video released this week by the Chinese Foreign Ministry, Beijing called Trump's trade war a deadly trap that deliberately targets China. The video left no doubt how China would respond. It likens bowing to US demands to drinking poison to quench thirst. It gave the example of Japan that has suffered decades of economic stagnation following the signing of the Plaza Accord in 1985. The stakes are so high for China that Beijing is already preparing its citizens for a potentially protracted struggle. China says it will never kneel down. The Financial Times reporting last week that China is insisting that the US cancel all unilateral tariffs as a precondition for any talks. Wall Street may not think so, but I think V is very high for both the US and China. All else being equal, this implies a long war ahead. But what about the cost? Will the cost prolong or shorten a war of attrition? The First World War is known as a war of attrition. One of the reasons why it lasted so long is that the two sides were evenly matched. It was not until the US entered the war that the balance shifted decisively in favor of the Allies. The Ukraine war, which is now in its fourth year, is also a war of attrition. Even though Russia has a bigger population and a bigger economy, Ukraine has been propped up by NATO support that has helped level the playing field and kept the war in effective stalemate for most of the last 3 years. In the US-China trade war, the fact that the US is a net importer and China is a net exporter gives the US the upper hand. And this does not depend who will be paying the tariffs. This is because even if the US consumers end up paying all of the tariffs, since the US government will be collecting the tariffs, it could use the revenue to reimburse the consumers if it so chooses. The direct costs of the trade war are greater for China than for the US. But the US will suffer high indirect cost. Trade diversion and reshoring are expensive. They will lead to higher prices, lower real purchasing power, lower corporate profitability, higher interest rates, and lower equity valuation will reduce household wealth. The share of US household financial assets that are invested in stocks is currently at an all-time high at over 40%. This is why Trump is so beholden to the stock market. While the costs of the trade war to the two sides are very different, it is not clear that they are higher for one side than for the other. This means we have no good reason to think that one side will back down before the other, especially given what is at stake. The 145% tariff the US has imposed on Chinese goods and the 125% tariff China has imposed on imports from the US will hit both economies hard. This is starting to show up in the manufacturing surveys of both economies. China's official Purchasing Managers Index fell to 49 in April versus 50.5 in March, the lowest reading since December 2023. The ISM Manufacturing Index declined slightly in April to 48.7 from 49 in March. Its price component is at the highest level since 2022. Manufacturing is a much bigger part of the Chinese economy than it is for the US economy. There were reports over the past week of factory closures, mass layoffs, and worker protests in China. I'm assuming we will hear a lot more such stories at the end of the Chinese Labor Day holidays next week. For the US, the main economic impact of the trade war will come through the price channel. But inventory is providing a temporary buffer against price increase. With a 41% spike in imports in Q1, my guess is that it will probably take one more month before we start to see broad-based price increases and shortages. The world's 5 largest container ship operators say bookings for eastbound trans-Pacific shipments are down by at least a third. The price increase will come not only from imported Chinese goods, but from the 10% tariffs on most imports from the rest of the world. These are not good news for the US stock market. But the market, buoyed by strong retail inflows, seems to have bought into Trump's claim that a deal with China is coming quickly, meaning without any economic pain. But is a deal coming quickly? This is what my logic says. 1. China will not negotiate unless Trump agrees to temporarily lower the tariff on Chinese imports to 10%, like for all other countries. 2. Trump and the China hawks know that doing this will weaken his hand not only with China, but with all other countries that will see it as a sign of capitulation. To me, what this means is that either the stock market is too optimistic about an imminent deal, or the deal won't happen until the economic pain of the trade war is felt more acutely in both economies. Either case, general equilibrium considerations said to me that the stock market has to go down. Time to start selling. Thank you for listening.